everyone. Welcome to Keerthi's FinFo NRI community. I'm CS Keerthina. I live in Dubai and run the consultancy, a financial firm specialized in NRI services. I've done my CS from India and CMA Advanced Diploma from UK. I'm also a SEBI registered MFT. As usual, I am here to help you to navigate the complex NRI finance with another subject. In today's video, we are going to address one of the dilemmas that every NRI investor has. Where to invest? US or India? If you want to create wealth in long term and use the compounding effect to create a passive income for financial independence, no one can deny the fact that stock market investing is one of the best ways. If you look at the history, the US market has created tremendous wealth for investors. The best of best companies have emerged from US, and even today the biggest tech companies are still in US. On the top of that, rupee has been continuously depreciating against dollar. So the average rupee depreciation against US dollar is still around 3 to 4% in a year. As NRI, you don't have that 20% LRs like resident Indians where they invest in US market, right? So NRI can easily open account and invest in US market. At the same time, NRIs recognize the fact that India is emerging as the most important resilient market in the world. It has potential to create great wealth to the investors if you have that time span of 10 to 20 years. In this situation, what should NRI do? In which market he should invest? US or India? Will Indian market generate better return? We are going to discuss this in detail. So stay tuned till the end. Most of the NRIs who earn in stronger currencies, just like I said before, there always will be one or another dilemma. What to do with this money? Where to invest? Is it Indian rupees or US dollar? To find the answer to this question, let's analyze India and US from 3+3 lens. That is, 3 short-term and 3 long-term. And if you like this kind of topics, don't forget to like this video, share and subscribe this channel. Now back to the subject. Currently, India is the fastest growing country with a huge young skilled population. India has population about 1.4 billions of people. It's the 5th largest economy with 3.75 trillions of GDP, that is in dollars. As on June 2023, India's current GDP growth rate was 7.2%. If you want to know how India is trying to stand out as an economic superpowerhouse, then compare that to today's US condition. In US, GDP is increasing at 2.1%, which I feel it's not bad because it's $25 trillion economy. To its size, 2.1% is still fine. But the worrying sign in US right now is these 3 things. These are the first 3 short-term reasons: interest rate inflation, rising debt, and interest rate hikes. The inflation in the US was around 3.7% as on 2023 September. The 10-year average inflation in US is 2.65%. In Indian economy, it's around 7% now. It may look more, but remember, Indian inflation average was around 6.01% when you take 10 years average. This clearly shows the inflation in US has gone up by 71% in last 1 year. In India, inflation has gone up by 16.4% in recent days when compared to its 10-year average, right? Let's look at debt to GDP ratio of US and India. You may know how US uses this Brahmastra to solve all its economic and financial problems. That is, printing dollars. That has led US debt to rise in economy. Currently, its GDP is 26 trillion and its debt is more than its GDP. It is 32.8 trillion. Whereas, Indian debt is just 624 billions USD and Indian economy is nearing 3.7 trillion USD. Less debt is always better, you know that, right? So India is a clear winner in this front also. Now let's look at the interest rate. Generally, in developed economy, interest rates are lower. But look at what is happening in US right now. It is around 5.5%. Remember, this was 0.5% in 2022. In India, the current interest rate is around 6.5%, whereas Indian interest rate was around 4% in 2022. So it's very clear. In US, it has gone up from 0.5 to 5.5%. That is 91% increase in last 1 year. Whereas in India, it has gone up from 4 to 6.5%. That is just 62% increase. Means India is doing better. Even in inflation control, it's performing better than US. In this aspect also in last 1 year. You all know high interest rates always hampers growth. On the top of this, in US, there is also a threat of de-dollarisation, geopolitical conflicts, lack of political stability which India does not have in current scenario. That should make every NRI to think twice before deciding where to put your money if you are the one who is believing only in US. I personally feel it is the time for you to diversify and to take a big bet even in India. Apart from the data I have given on inflation, debt and interest rate, there are 3 more long-term reasons for you to take seriously. Consider investing in India. Let's start with the first one. That is emerging sectors. Means you have to identify which theme you want to bet on. In S&P 500, 26% of the allocation is in IT sector. In case of Nifty 500, which we can compare directly to US S&P 500, highest sector weightage is in financial services. So if you want to have exposure to tech, the best strategy is to create portfolio in US stock market because it is a platform where the largest giant tech companies are listed, such as FANG. You know what is FANG? Facebook, Amazon, and Apple, Netflix, Google, etc. On the other hand, post demonetization and even digitization push of the government, financial services and banking, it's quite robust theme in India. So if you want to have exposure to this theme, then the place is India. Not to forget, India has youth with rising per capita income. Indian government has decided to make India as a fully developed nation by 2047. What does that mean, The government itself is estimating that in this transition phase, per capita income will increase by 7.5 times per annum. That is as per SBI research I'm quoting. If you observe 2023 developments, in S&P 500, the performance can be traced back mainly to the technology companies. It's because of Apple, Microsoft or Nvidia, etc. But if you exclude this big tech rally, Indian Nifty did better on various other themes, whether it is FMCG or automotive sectors. And you can also see that the gain is across various themes. And it is widespread. It is not limited to one theme, just like tech in S&P. So, what appears on the surface or what is hiding behind these numbers? They can be two different things, right? So, you have to decide whether you want to bet on one particular theme or you want to track the widespread growth. Second is performance. S&P 500 had delivered 12.69% return in last 5 years. I'm taking it in rupee terms. Nifty 500 had given 14.74% annualized return. So if you stretch it back, then the story will be slightly different. S&P 500 did well because of various factors, such as strong dollars and high performance of these FANG companies, or even take the example of Berkshire Hathaway, which is in S&P 500, right? So these companies have global operations and they get revenue from these global operations at that scale. Whereas in Nifty 500, the focus is on the domestic market. Majority where the companies like Reliance, HUL or TCS, etc., they are driving the growth. But the recent figure says you cannot extrapolate the data. Why? Because the trend of de-dollarization has begun, and in the 5 years, when you compare the figures, it's clearly evident. In Nifty 500, though the focus is on domestic, is giving better return. Third one is diversification. We know that we should not put all eggs in one basket theory, right? Diversification matters a lot. Imagine it's like a seesaw. Portfolio, if you have constructed it like a seesaw, it's always going to protect you from any kind of unexpected loss or volatility because things are moving in opposite direction. This is called, actually in theory, correlation, extent to which two variables are moving in same way. Now, if both the market are moving in same direction, when it crashes, everything is collapsed. So no hedging possibility at all, right? As an NRI, we should see this correlation factor a lot. Correlation of 1 means variables are moving together. -1 means this is inverse. 0 means there is completely absence of any correlation. But now between India and US it is 0.67%, which means you have to do this diversification strategy with lot of caution. So consult a financial advisor before you decide what proportion should be in US and India. However, the safe haven belief makes NRIs to prefer USD over emerging markets. But where is a big growth opportunity? It is in emerging markets like India. As an NRI, you have easy access to both US and Indian markets. Do a well thought out plan considering a top-down approach. That means economy, industry, company analysis. This can help you to allocate the funds very well, generate maximum return to the maximum extent possible. Also managing the risk. This is my belief. What do you think about India's story? How are you allocating for US or emerging markets including India? Comment below. That's it for today. I'll meet you again with another interesting topic. Till then, bye bye.